This video covers Chapter 8, specifically a vertical bear spread. Now, the word vertical has to do with the way CBOE, Chicago Board of Options Exchange, and newspapers often publish options pricing data. They often publish for a particular maturity a strike, say, of $10, a strike of $11, strike of $12. And so what we're going to be doing with a vertical bear spread is we're going to be looking at two different options. In this case, we're going to be using put options, where vertically you're going up and down with different strikes. Okay? So that's what the vertical means, two different strikes. The word bear means we're going to make money. This is a strategy that makes money on the downside. So when you're all said and done, when the stock drops, you have to make money in this strategy, or you did something wrong in your analysis. There are bear spreads, and bear spreads make money when the stock goes up. Bull spreads make money when the stock goes up. Now, the word spread means that we're going to be buying and selling. In this case, we're going to be buying and selling puts. And they offset each other to some degree, but not perfectly. And they're going to offset in this case so that you make money on the downside. That's why it's a bear spread. And you're going to lose money on the upside. So before we actually get into the tables and graphs, let's just look at it graphically of what we want to do. Normally I like to put together the table first and then explain it with a graph, but I think it's worth looking at the graph early. So here we have stock price at expiration, same old thing. So let's say we have a strike, say, let's call it 13. Strike of 13. And we would, in this case, let's say we're bearish on a stock. And if we had a strike of 13 for a put, our profit would look something like this. For if we were to purchase a put. And if you're bearish on a stock, remember, that's what you want to do, purchase a put. But let's say you're not totally bearish. In other words, you don't expect the stock to drop too far. You don't expect it to go down too much further. And so you don't expect this to happen. And you don't expect to make a profit. So why should you pay this premium? Let's say this premium's $4. Why should you pay this $4 premium? Which gives you the ability to make money all the way down here when the stock drops all the way to zero, when you don't expect this to happen. So you can take advantage, you can engineer a way to get out of this. So you can offset your costs, and when you offset your costs, you're going to also rearrange your risk and return trade-offs. So what if we buy a put option? Let's say the strike would be 8. We don't expect the stock, so we're going to buy a put with a strike of 8 because we don't expect the stock to fall below $8. We just don't think that this is going to happen. So this is not in our horizon. We don't expect this to happen. So what we'll do is we'll sell a put option to offset the cost of this long put. And so we sell a put option with this strike, it's going to look something like this. For a profit. Okay? And so what we're going to have is we're going to have a long put, short put, two different strikes, and the profit is going to look like something like this. See if I can draw it right. It's going to look like this, something approximately like this. You see with this purple line, you're making money in this area. You're making money at below the strike, you're making money here, and then there kinks at the 8, and then it kinks at the 13, and here's where you're losing money on the upside. Say you start to lose money at this point, you lose money, and your floors, there's a floor in how much you can lose, and there's also a cap to how much you can gain. But what'll happen with this situation is you'll be able to make money on the downside. Not as much as you'd like if the stock fell all the way, but you don't expect it to happen. So this is what we're doing, and that's what spreads do. They offset themselves to some degree, and when you offset your risk and return to some degree, you lower your costs. And so here what we're going to do in this example, we're going to call this K equals 1, K1 equals 8, and we're going to have this K2 equals 13. So we're going to have two different puts. And so that's what we ultimately want to do for this situation. So let's go into the example, and I'll build by building the table. So let's say stock price is at 10. Let's say K1 is $8, and the put price for this option is $2. And we're going to short it. In other words, we're going to short this put, sell this put. Okay? And we're also going to have another option with a strike of 13 and a price of 4, and we're going to buy this put. Okay? We're going to buy this put. And now what we want to do is we want to build a table around this. And so the table will have, let's just say the table will have stock price ending at 5, stock price ending at 8, stock price ending at 15 at expiration. And so you're going to have put 1, and then you're going to have put 2. And put 1, this is where K1 equals 8, and that's short, so it's a little bit of, all I'm doing is just putting some information here so we don't get lost in the table. It's a little cheat sheet. K2 equals 13, and we're going long. Okay, now we have a payoff for the option. We have a premium, and then we have the profit on this option. And the same thing here. And we add these two together, so we're going to analyze each option by itself and then add the two together, and we'll have our, I'll just call it a plain old bear spread. It's a vertical bear spread, just call it a bear spread. Sometimes the word, when you read this in other texts, in other material, it will often be just referred to as a bear spread. And as soon as people see the word bear, the two words bear spread, they know it's a strategy designed to make money when the stock drops, and that there's an offsetting position to some degree. There's not a lot of risk here, and there's not going to be a lot of return either. Okay, so let's dig right into it. Let's look at put 1 here. Put 1. Now we shorted the put, and we have to remember what the payoff is on a shorted put. It's this. If the stock price is less than the strike, it's 0 otherwise. Okay. Now the payoff here is going to be K is 8. K1 is 8. I should put a little 1 here. K1 right here. K1 minus the stock price is going to be minus 8 minus 5 is minus 3. So that's my little cheat sheet right here. You can erase that. I'm not going to add it up. So it's minus 8 minus 5 is minus 3. The premium on this short I've collected is $2. Collected the $2 in the short put. 2. And so overall, I lost $1 on this put. Okay. Let's do. Let's go across so we keep our mental framework here. It's a little easier when you do this to go across using the same put option. Then we'll come down to put 2. So now we have a strike of 8. The strike is at 8. And the stock is at 8, so the payoff is 0. We collected a 2 premium, so we made $2 on this option. Okay, we sold an option that was worthless. And the same thing here, the payoff is 0 because the stock is above the strike of $8. We collected 2 and we made 2. Okay, so don't forget, erase this so you don't get confused in the adding. Okay, now let's do the second put. Now, the second put, we purchased the put, so that's K minus ST at expiration, or 0. And in this case, the option, it's in the money by $8. So it's 13 minus 5 is $8 positive. The premium that we paid, that we're going to pay, is 4. So we made $4 on this option, and overall we made $3 in this situation, which is already a good sign, by the way, because the stock fell. We have a low stock price and we made a profit. See that? So things are looking good so far. So when you go through these tables, they should make sense. You should be able to intuitively check to make sure things make sense. If we lost money down here, you'd start to ask yourself, did I do it right? Because the stock is falling. The stock is at $10. It fell and we lost money? No. We should be making money on a bear spread. Okay, now here we have at a stock price of 8, the payoff is going to be 13 minus 8, which will be 5. Okay. Erase that little thing, and then we have a premium that we paid of 4, so we made $1 on this particular put, and overall we made $3. Looks like a flat line, right? Flat line at a profit of $3 on the downside. Now continue. This option is out of the money at 15, but you paid 4. And so you lost 4 in the option, and you lost $2 on the upside. Okay. So now, when you graph this, K1, K2, 2 Ks. First of all, before you draw it carefully. Okay, let's do the first. This is the option we bought, and we bought it for $4. So this has to be minus 4 here, and then and this is 13, and this is 8. It's going to look something like that. The first put, or that's put 2. Put 2, which is the purchase put, and then we have a the shorted put, which we collect $2 on. Notice that the difference here is only going up $2, and here it dropped 4. So I'm trying to get my geometry straight. We know it's going to kink at 8 here, and so notice what happens. The old rule of adding up the slopes. You have a slope of -1, a slope of +1. They're going to offset, so it's going to flatline below 8. And then look at above 13. There's 2 flat lines. The slope of 0 and a slope of 0 is 0, so it's going to flatline here. And what about in between 8 and 13? Well, you got a slope of +1 and a slope of 0, which means it's going to have a slope of +1. It's going to look something like this. It's going to kink. Okay, that's the purple line. That's basically how it's going to look. And I can drop this number in. This is the 3 that comes off the table. This is the $3. I'm graphing that right here. And then the maximum I'm going to lose is $2 on this option. And that's got to be, I'm not quite drawn the scale. but this is 4 and this is 2. And so overall, that's going to be my my profit profile on the bear spread. And here I am making money. Here I am losing. I didn't make money in this area. When the stock fell below the strike, I didn't make any additional money like I did if I just would have bought the one put by itself, because I wasn't expecting this to happen. So why pay for it? If I don't expect to make this profit, why pay for it? What I'll do is I offsetted that by selling this put, and so I made my profit in this area. So really, you're looking at profits around in this area. Now, so that is a vertical bear spread. Now let's do a straddle. Straddle is another combination of options alone. So you notice in this bear spread, by the way, we didn't own the underlying stock. We just bought a put and we sold a put. That's it. We didn't own the underlying. Same thing's going to happen with this straddle. So let me right here. Straddle. Straddle, what we're going to do is we're going to buy a call and buy a put on the same stock with the same strike. So let's say, for example, I get a stock of 20. I have a K of 20. And I'm going to have a call worth $2.57, and I'm going to buy it. And I have a put worth $1.40, and I'm going to buy that. So I'm buying a put and the call, 2 purchases. Okay. Now, before we go any further, let's see what this is all about. Just roughly drawing the old hockey sticks here. When you buy a call, it looks like this. Okay, that's the call purchased. When you buy a put at the same strike, it's going to look like this. When you add the two together, what you're going to get is, look, you're going to get a slope of -1 and a slope of 0. You're going to get a slope of -1. Slope of 0 and +1, it's going to look like this. So you're basically going to end up with profits on the upside or the downside, and you're going to lose money. See, we're losing money from here to here. We're losing money. If the stock price is relatively stable, we lose money. That's exactly what we don't want to happen. So with a straddle, you have no idea which way the stock is going to go, so you can't predict it. You don't have any predictions for the direction, but there's one thing you are predicting. You're predicting that the stock is volatile. There's going to be some type of extreme news coming out on this stock that's either going to push it way up or it's going to push it way down. But you don't know the direction of that news. Is it positive news or it's negative news? Maybe it's around an acquisition. And if the acquisition goes through, it's going to be great. The stock's going to hit a home run. We're looking particularly at the stock the company that's being acquired. And so if the acquisition goes through, maybe there's a really nice premium on the stock, in which case it's going to push the stock up tremendously. But if it falls through and the merger doesn't take place, the stock will drop. Because the price right now is reflecting a little bit of the possibility of a merger going through. This, by the way, is a classic insider trading strategy. Insiders, this is an illegal trading strategy that the Securities and Exchange Commission watches really closely. They look for straddles and also what's called strangles on particular stocks where there's news about mergers and acquisitions. Because what happens is, if you're an insider and you don't have a lot of money and you know that the stock is going to go up or down, these traders will use options to take advantage of that. So because the options they don't cost a lot of money, but the stocks often do cost a lot of money. For example, look right here. The stock is at $20. You're gonna have to plunk down $20 to get a position in the stock where you can buy puts or calls that are 1/10 or less of that approximately. Okay, let's go into this example building a table now. Again, remember, S equals 20, K equals 20, C equals 257, P equals 140, and we're buying, Okay, now let's run the following scenario. Let's say the stock is at 10, 18. Let's go all the way up to 30. So we've got quite volatile. So what I'm doing is I'm making these scenarios extreme so we get some volatility. Okay, now we have a call that we bought. And so we're going to have a payoff, and we're going to have a premium, and we're going to have the call profit, and then we're going to have the put. And then we're going to have the straddle. Okay, now we know what the payoff on a purchase call is. It's ST minus K if the stock price is above the strike, and it's 0 otherwise. Okay, now if the stock price is not above the strike, the holder of this, which is you, in this case, will never exercise the option and buy it for 20 when it trades at 10. Doesn't make sense. But you paid $257 for it. So you lost $257 on this call. Now let's go right across. Stick with this option, this call option. Now the payoff here is 0. Again, why would you buy the stock for 20 when you can buy it in the open market for 18? The option's out of the money, but you paid $257. Now, $30 stock price. You're going to be making money. Remember, when you buy a call, you're going to make money on the upside. So this option, you're going to make $10. You're going to make 30 minus 20 is 10. But you paid $257 for it, and so this is $743 on the upside, positive. Okay, let's do the put. So the payoff on the put is going to be, remember, the formula for it is it's K minus ST if the stock is less than the strike, right? And 0 otherwise. Here the option should be paying off because the stock is down, so it's going to be 20 minus the 10, and it'll be $10. We paid $1.40 for this option, so we made $8.60 on the option under that scenario. And then overall, we made $603 for the straddle itself, this plus this. Now, at $18, we make $2 on the put, because 20 minus 18 is 2. We paid $1.40, and so we made 60 cents here. Overall, we lost $1.97 on the straddle. And then here, the option's out of the money. We paid $1.40, so we lost $1.40 in the option. And overall, we make $603 on this option. So, notice what happened. We made money in extreme volatility, but we lost money when the stock was relatively stable. So make sure we have that all in there. Now, graph. We bought the put. Or, yeah, the put. Let's see, the put cost $1.40. So this would be minus 140 here. And then we bought the call, which cost $257. So this is the call. This is the put alone. Okay. Now, let's combine the two. Combine the two with the help of our table. Now notice what happens. We're going to make money. That's not going to help us. Let me just show you. The results are going to look something like this. And that, you got to be careful. These two lines should be perfectly parallel. Okay, they should be perfectly parallel. Here I got the parallelism pretty close, so that's good. And so here, and this should be, by the way, centered on 20. So the most you're going to lose if the stock stands perfectly still, you're going to lose the value of both options, which is you're going to lose right here $2.57 and $1.40. You're going to lose $3.97 right at that point. Okay. And at a price at around $10, you're going to make a profit overall of $6.03. And then at a price of $30, somewhere over here, and I don't have it drawn the scale, you're going to make $6.03 also. So again, you lose money if you're in this area. You're going to lose money. That's stability in the price, and you're going to be making money with volatility up or down. Now, I made a speako, so to speak. I misspoke a few minutes ago when I talked about insider trading. You probably don't want to do this with insider trading. Insider trading, you just buy call options if you knew what was going to happen. If you had the inside information that a particular trade was going to happen, the Securities and Exchange Commission is looking for people buying puts, or excuse me, buying call options if you had that insider information. If you had inside information that the merger was not to go through, then you would be just buying puts by themselves. Because if you knew that negative information, then you'd make the money on the downside when the stock fell. But if you had insider information that the merger was going to go through and it was likely going to push the stock up, you'd just buy the calls. It wouldn't make sense if you were an insider to do to do a straddle by buying a put or a call, because you'd be offsetting some of your gains. Because you'd be, for example, if you had just upside information, you'd be offsetting that gain by the fact that you had to buy the put. So I guess, if you were a nervous insider, you might want to do a straddle, to hedge your bets. Maybe you're an insider and you're not quite confident that your tip is going to work, so maybe you would hedge your bets a bit. And this would work. This straddle would work, but it's typically not the way it's presented. It's usually insiders get the information, and if they know it's positive, they buy a ton of call options because they can leverage it up. The calls are cheap. Or if they got the negative news, they just buy put options.